The most dangerous crises start where nobody is looking. This one began with a promise about a currency most traders couldn't place on a map, and it ended 15 months later, an ocean away. 14 of the most powerful bankers alive locked in one dining room, writing a check nobody had budgeted for. This is the story of how a broken promise crosses an ocean. First, feel the boom. Through the mid-1990s, East Asia was where the future was being built. The fastest-growing economies on Earth, year after year. Money poured in from Tokyo, from London, from New York, all of it chasing the miracle. Factories rose out of rice fields, harbors filled, skylines climbed. And a river of that foreign money flowed through one particular door, Bangkok. Because Thailand had built its door out of a single, beautiful promise. Through the 1990s, Thailand ran its economy on a simple promise. The baht would always be worth the same in dollars. The peg had held for more than a decade, and everyone believed it. Belief changed behavior. Thai banks and companies borrowed billions in dollars, it was cheaper, and spent them at home, because the peg made the exchange rate feel like a law of nature. Notice what has quietly happened here. An entire country has taken one side of a single trade. If the promise ever breaks, every borrower in the nation loses at once. This is market memory, the crashes, manias, and rescues that built the modern market, told so you can use them. Today, 1997, how a broken promise in Bangkok chained around the world and ended inside a private dining room at the Federal Reserve. Now, whenever doubts surfaced, a finance minister would step in front of the microphones and repeat the promise. The baht will not devalue. But listen to the trap inside that sentence. The louder a government swears its peg can never break, the more its people borrow as if it never will. The promise and the danger grow together, and by the spring of 1997, both were enormous. By 1996, the boom was wobbling. Exports slowed, property stood empty, and the traders who hunt weak promises began to test this one, selling baht, forcing the central bank to buy it back with its dollars. Thailand fought them in secret and spent nearly everything it had. That is the cruel arithmetic of a peg. Defending it costs reserves, and reserves are finite. The promise held right up until the vault was empty. On the 2nd of July, 1997, the money ran out, and Thailand let the baht go. It lost half its value within months. Every company in Bangkok that owed dollars watched its debts double against its earnings. The promise was not just broken, it was inverted. What happened next had a name bankers only whispered: Contagion. Foreign lenders looked at Thailand, then looked at their loans to Indonesia, to Korea, to Malaysia, and asked for their money back. Everywhere, all at once. A bank run with countries for banks. Within a year, the Korean won had lost roughly half its value. The Indonesian rupiah lost more than 3/4. The International Monetary Fund assembled the biggest rescues it had ever mounted, one after another, and still the dominoes kept falling. To feel what that meant on the ground, in Seoul that winter, families queued to donate their wedding rings. Gold collected door to door to help the state pay its foreign debts. More than 200 tons of it. And remember the mechanics of every run you have ever seen. It is not the loss that kills, it is the speed. Money that took a decade to arrive left in a season. The lenders who took it out were already asking the next question. Who else is holding a promise that can break? The answer arrived in August 1998 from outside Asia entirely. Russia, oil cheap, budget bleeding, did the thing the textbooks called impossible. It devalued the ruble and defaulted on its own government debt in the same breath. A nuclear power stiffing its lenders. Every model on Wall Street treated government debt in your own currency as the one thing that cannot default. Every model was now wrong. And one fund in Connecticut was about to prove exactly how wrong. The fund was called Long-Term Capital Management, and it carried the best resume in the history of money. Its founder had run Wall Street's most feared trading desk. Two of its partners had just won the Nobel Prize in economics. Their machine hummed quietly in Connecticut, far from any trading floor you have ever seen on television, and it ran on one fuel above all: borrowed money. The method? Find two nearly identical bonds priced slightly apart, bet the gap would close, and, because each gap was tiny, borrow enormously to make tiny gaps pay. At its peak, the firm controlled well over $100 billion of positions, resting on a few billion of its own capital. 25 borrowed dollars riding on every dollar of its own. The trades were clever. The size was the real bet. For 4 years, it worked like a machine, a founding investment multiplied more than 4 times over. Then Russia defaulted, and every nearly identical gap on Earth widened at once, because every leveraged fund was suddenly selling the same safe things to cover the same losses. In 5 weeks, Long-Term lost almost everything it had made in 4 years. By late September, the fund was down to its last sliver of capital, and its positions were tangled into the biggest banks in the world. One final door. 15 months after the promise broke in Bangkok, on the 23rd of September, 1998, the heads of 14 banks were summoned to a dining room at the Federal Reserve Bank of New York. Not to save the fund's partners, they were wiped out, but because cutting the fund loose would set fire to every balance sheet in the room. The banks put up $3.5 billion of their own money, took the positions over, and unwound them slowly. No taxpayer cash, but the referee had called the meeting. Within weeks, the Fed was cutting rates, 3 times in 3 months, to calm a world that had just discovered how connected it was. Put yourself at that table. Every banker in the room despised this fund. It had outtraded them for years. And every one of them still wrote a 9-figure check to keep it standing. Not out of kindness. Because in a real panic, the fire next door is your fire. That is what contagion means when it finally reaches your own balance sheet. So what do you carry out of 1998? 3 things, and they have aged terribly well. A peg is a promise, and promises get tested exactly when they are expensive to keep. Contagion does not travel by geography. It travels by leverage, through whoever borrowed to hold the same trade you did. And diversification is a fair-weather friend. In a real panic, correlations go to 1, and all trades become 1 trade. The market can stay irrational longer than you can stay solvent. 1998 is the year that sentence was carved over the door. That's market memory. Next episode, the greatest bubble in the history of land, when the grounds of one palace in Tokyo were priced above the whole of California in the 30 years it took to come home. Follow so you don't miss it. Full library at agenticsovereigncapital.com. Education, not investment advice.